The S&P 500 just pushed to 72.59. It's a number that looks perfect on the surface. Record territory, bullish headlines everywhere. But if you're a professional, if you trade the real market and not the headlines, you're seeing something deeply unsettling right now. Look at your screen. The price is up, but the engine is dead. We have a massive momentum failure brewing across multiple timeframes. Most retail traders are about to get trapped chasing this breakout, and I'm going to show you exactly why. I'm breaking down the specific bearish divergence that has a 70% probability of resolving lower, and I'm giving you 3 precise entry strategies to trade the downside from here. If you trade the US indices, don't touch your mouse until you see these levels. Welcome back to Alpha Market Meridian. I'm here to turn volatility into profit, and right now, the S&P 500 is serving up a high probability contraction pattern that we need to respect. Let's get straight to the data. Here is the direct conclusion for today, May 6th. The S&P 500 is in a critical distribution phase. The trend on the daily chart is technically still bullish. We are above all major moving averages, but the short-term structure is exhausted. The market is screaming overbought with a bearish divergence. My line in the sand is 7,300. Above that, the bears capitulate and we chase liquidity to 7,400. Below 7,200, the daily close, the trap is sprung, and we are looking at a rapid mean reversion to the 7,000 handle. I am leaning short on a rejection of these highs, and I'll tell you exactly how to play it. Let's zoom in, because this is where the bodies are buried. As you can see on the 4-hour chart in the data you've sent me, the price is grinding along the upper band of a rising channel, currently at that 7,259 level. But look at the last 3 candles. We are seeing high wave patterns, indecision at the top. Now, the critical technical anomaly is in the moving averages. On your screen, the 60-minute chart shows the price at 72.59, but look at the slope of the 5-period MA, it's flattening dangerously. The price is clinging to it. We have a bearish alignment forming on the 60-minute oscillators. The RSI, 6, is reading 76.33. That's not just overbought, that's extreme territory. But here is the killer. It's starting to roll over while price hangs at the high. That is the textbook definition of bearish divergence. Drop down to the 4-hour view. The MACD, 12.26.9, is showing a reading of 80.66, still positive. But note my words, the histogram bars are shrinking, and the signal line is flattening. We are 3 bars away from a momentum crossover to the downside. The CCI, 14, at 136.02 is starting to dip out of the overbought zone. This is not a crashing signal yet. It's an exhaustion signal. The market is breathing its last breath on this leg up before a meaningful correction. Swinging to the daily chart, the trend is undeniably intact. We are miles above the MA200, which is sitting way down at 52.84. The MA5 at 71.19 and MA10 at 68.42 are still in a bullish expansion. But I want you to look at the volume. We recorded a relatively high volume bar on the push to 72.73, but since then, the volume has contracted on these small body candles. New highs on declining volume is a classic divergence. The bulls are running out of ammunition. The BBI, multi-period MA, is at 6,992, acting as the magnetic zone for any correction. And look at the bias indicator on the daily. It's at 3.26, starting to hook down. This tells us the deviation from the mean price is too high. Gravity has not been repealed. We are stretched 200 points above a reliable mean, and historically, that debt gets paid, fast. Why is this happening now? Context is everything. The market is pricing in a Goldilocks scenario: easing inflation, potential rate cuts from the Fed, and resilient earnings. But the buy the rumor, sell the fact dynamic is in play. We've priced in the perfection. Now, the fear of a hawkish hold is creeping back into the bond market. If you look at the DXY, the dollar is showing relative stability today, which caps the upside in equities right here. Here's the crucial cross-asset verification I promised we'd cover. Look at Bitcoin. BTC USD is stuttering right at a key risk pivot, failing to confirm a risk-on break with equities. When the S&P 500 hits a high and Bitcoin fails to follow through with a higher high of its own, that is a profound red flag for the entire risk-on complex. It tells us the most. Speculative capital is cautious. We also need to watch gold. XAU or USD is holding firm, indicating that while equities are pricing in a soft landing, the gold market is still pricing in a lingering stagflation or geopolitical risk premium. This intermarket divergence between equities, crypto, and gold is exactly why I'm fading this SPX rally. The narrative is fracturing. For the rest of this week and next, the bias is for a corrective pullback to the 7100 to 7000 zone. The only event that would kill this bearish thesis is a daily close above the psychological 7300 barrier, which would signal a blow-off top and trigger massive buy stops. Keep your economic calendar open for the upcoming CPI whispers. Any heat in inflation will be the match that lights this sell-off. Let's turn this analysis into money. Here is strategy 1, the conservative play for high certainty, low risk positioning. You are selling the failure, not the top. Wait for the 60-minute candle to break below the 4-hour MA5, which is currently standing near the 7,207 level. You need a definitive body close below 7,200. Entry. Sell stop at 71.95. Stop loss. Place a tight at 7,239, just above the session low. The logic here is simple. If the price goes back to bargain hunting territory at these highs, the failure has broken, and you don't want to be short. Target 1, 71.40. This is the prior consolidation support. Target 2, 7,100. The psychological pivot and MA10 dynamic support. The risk-to-reward ratio on this is approximately 1 to 3. Move your stop to break even the moment target 1 is hit. Strategy 2 is for the standard swing trader who can handle a bit more noise. We are fading the extreme deviation using the daily BBI indicator. The market is screaming overvalued relative to the daily MA20. We wait for a micro rally back to the 7,270 resistance zone. We are looking for a failed retest. Entry. Limit sell order at 72.70, with confirmation from a 15-minute bearish engulfing pattern. Stop loss, 73.05. We are keeping the stop above the round number to avoid noise. Target 1, 6,992, which is the daily BBI. This is the magnetic moving average I mentioned earlier. Target 2, 6,876, which is the MA20. This is a high probability mean reversion trade. The expected reward here is nearly 400 pips, versus a 35 pip risk. This is how you build a high Sharpe ratio trading book. Strategy 3 is the high risk, aggressive momentum breakout short. This isn't for everyone. This is only for people who can react instantly and accept a narrow stop out. You're betting the trap is already sprung, and we accelerate down into the close. Watch the 5-minute chart for the breakdown of 7,200 with heavy volume. Entry. Aggressive market sell if price pushes below 71.98. You need a 20 pip confirmation candle, no wicks allowed. Stop loss, 72.20. Ultra tight, 2 points of risk. Target, 71.50, the day's open interest pivot. This strategy is a coin flip on probability, but it pays 5 to 1 if we catch a liquidation cascade. If the price battles back above 72.10, you're immediately wrong. Accept the scratch before you pull the trigger. Let me hear from you in the comments. Are you seeing this bearish divergence, or are you buying this dip with both hands? Type your SPX short entry level in the comments below. Let's track the live sentiment right here. Now, let's talk survival. The risk management bell must ring before we execute. No single position should risk more than 1 to 2% of your trading account on this index trade. The S&P has a nasty habit of staging a short squeeze precisely when the technicals look bleakest. Your stop loss is your seatbelt. If Friday's unemployment data surprises to the downside or CPI prints cold, this bearish thesis evaporates. Set the stop, respect the stop, and live to trade another day. To summarize, the S&P 500 is a bear trap in the making. The strategy is to sell strength below 7,300 and target a rapid correction to 7,000. The downside risk now far outweighs the upside reward. Tomorrow, we are laser focused on the DXY and the US dollar index response to these equity highs. That will determine if this is a full market reversal or just a sector rotation. And a special shout out, we will be reviewing the Bitcoin divergence signal in detail, because if crypto leads equities down, we've got a much bigger storm coming. Make sure you smash that like button if you're fading this rally, and subscribe to Alpha Market Meridian. We are the only channel that blends pure institutional order flow with actionable, retail-ready strategy. I'll see you in the next breakdown, where the volatility is your portfolio's best friend. Stay sharp.